ETFs, and I think we'll have a very good panel to talk about a lot of things going on. And Allie Doyle of NASDAQ is the moderator. So Allie, take it away.
Thanks, Jim. All right, hi everyone. So like Jim said, I'm Allie. I work in NASDAQ's ETF listings business, and I'm going to give the panelists here a chance to introduce themselves, where they work, and then we will get going. So Pete.
Hi, I'm Pete Baden. I am with Genoa Asset Management. We're part of FM Investments. FM is kind of a collector of boutique money managers. As far as my career, it goes all the way back to before Black Monday, goes through the S&L crisis, goes all the way up until we had irrational exuberance, Great Recession, and then the pandemic. So it's the way I like to think of my career, as all the bad things. And then we recently launched this thing, I think it was called a single bond ETF, and everybody was excited because it was different than the single stock ETFs, and so we've made a little bit of a splash.
Good morning, everyone. My name is Kurt Meyer. I work with Syntax Indices down at One Liberty Plaza. And first of all, I'd like to open up with a very heartfelt thank you to Allie for hosting, and then also ETF Global for having us here. So my day-to-day line of work is in the commercial distribution of our data and technology. So essentially, we're really aligning here with 15 data scientists, if you will, to commercialize and distribute an affinity data set of multiple different ways to classify and work with our unique financial technology. And as we were talking about earlier on, what does innovation mean to you? There's probably at the intersection of three elements, right? Isolating a valuable problem to solve, finding the technology to solve that, and then monetizing that. So I think of innovation as those three components coming together, but at the end of that, there's no finish line to it. And this room's a glaring example of that, right? In 25 years, the ETF space, 10 trillion in assets, 105 issuers, and it just keeps going and going. So thank you very much for having us, Allie. Appreciate the time, everyone.
Good morning, Bruce Levine. I'm the CEO of Nightshares. We're a new ETF company that started and launched our first funds just about 5 months ago. But my history goes pretty far back in the ETF world. I was part of the original team that founded iShares, and I ran product development and was the CFO there. I have launched actually some of the ETFs today that are staggeringly big. And after that, I joined WisdomTree in 2006 as the president and chief operating officer when it was starting up. And I spent about 15 years there and recently just came off the board there to do Nightshares. Very excited to tell you a little bit more about the Nightshares story. In terms of innovation, lots to talk about, but I'll wait for the questions.
Thank you, everyone. My name is Andrew Channon. I'm co-founder of ProcureAM. We're a thematic ETF specialist issuer. My background starts off from out of school working on the floor of the American Stock Exchange with Kellogg Group, where we were the largest ETF specialist trading firm at the time. And it was a great time to understand the ETF ecosystem. This was back in 2007. There were a little over 200 ETFs. I could have named every single one, the tickers and the top 3 holdings in them. And now that would be really impressive if anyone could come close. From there, I was poached to be a prop trader and helped build out an ETF prop trading desk. While I was there, I gave a bunch of ETF ideas to existing issuers. One of them went off and launched many of them, which are still successful products today. And eventually one of their principals said, why do you keep on giving us your ideas? You try launching your own. So I switched over from the trading side to bringing products to market. So I started a company called Pure Funds, where we're the sponsor of 10 different first-to-market ETFs. There's a whole bunch of other stuff you can read about that firm. And I started up another company in the midst of what was going on there, and we created Procure, which has the goal of creating many first-to-market ETF strategies like space as well as disaster recovery strategies.
Awesome. Thanks, everyone. So Bruce and Andrew, I'm going to start with your perspective. So, innovation can oftentimes go hand in hand with entrepreneurship and, being at a smaller, maybe more nimble company. So from that perspective and, from both of your experiences, talk to us about the product development cycle for a new innovative type of product, and what are some of the advantages or disadvantages that you feel, whether it's being at a more larger incumbent established company or something smaller and more nimble. So maybe Bruce, I'll start with you.
Thanks, Allison. So, it kind of depends where you are in the life cycle. When we started iShares was unknown. Barclays Global Investors, who was sponsoring the business, was unknown at the retail level. They were a pension fund manager. And we had a few resources at our back, but not that many. And but we had righteousness on our side, as we all know. We knew the structure was a huge improvement upon what existed, and so we went at it with ferocity. And but the point being that iShares today is massive, and it's very easy today for them to launch a new fund and have instant credibility that brought to you by BlackRock. It's going to do something good. It's a well-made fund. They're not going away. Some of the things that new companies have to deal with, they don't have to deal with. I would tell you that the bigger source of innovation comes from the little guys. Just like iShares was a little guy, WisdomTree was a little guy back when there was only dumb beta, and now there's smart beta. And I'm a little guy now as NightShares, but I have a big idea, right? And so, I think the challenge is, you heard some on the last panel, around just, the chicken and egg problem, let's call it. And that's definitely, a challenge. But I think when you think of historically true innovation, it tends to come from the non-incumbents in any industry. The incumbents are saddled with legacy success, basically, and so they don't want to rock the boat. And so, that I don't know if there's ever going to be a structure that supplants the ETF structure. I know people have tried, but if there is, it's probably coming from outside the industry. So I think, it's a mixed bag in terms of the opportunities are greater for little guys, but the day-to-day launches are certainly easier if you're BlackRock.
So for better or worse, I never had the experience of working at a large ETF issuer. So a lot of the things that we try to learn is on the fly and figure out how do you get your product out. And from the early days, it seemed like, is my mic on?
I think, is your mic, yeah?
So from the early days, it seemed really difficult to be able to just create products. And so many people would work with white label providers as a way to get their products off the ground. But really being able to have your own RIA and be able to issue your own products, when you're a smaller firm, like you said, you can be as nimble as you're able to be. And for us, that's been really important, because when you try to do first to market products, being first is probably the most important part of that equation. So the way that we've looked at innovation is trying to find these ideas that we believe people want to get exposure to. Many people aren't experts in some of these very highly technical industries, and being able to invest in a fund that gives you instant exposure to 30, 40, 50, 60 publicly traded companies, either domestically or from around the world, was an interesting way to be able to provide investors with exposure to innovation. And we've done it historically going after specific industries or technologies, and that has seemed to be a popular way. However, you run into the problems of how do you get the message out there, and different media agencies have all upped the ante for what they want to see for a fund before they're willing to talk about it. Platforms and wirehouses have started to build up the walls and make it more difficult for products to make it on there, especially for newer, smaller issuers. So it is absolutely an uphill battle for newer companies, but we've seen some of the most successful products that have been issued over the last couple of years. Many of them have come from smaller independent issuers. So we've seen ideas like interest rate volatility has picked up in tremendous popularity. We've seen buffered funds. Yes, some of these have come from people with experience in the industry, but newer companies as well. So the great thing is when there is demand for these types of products, and not every single product is going to have demand, but when there is demand, typically there's a way for investors to be able to access those exposures.
Yeah, great, thanks. So speaking of new ETFs or being new to ETFs, Pete, I want to ask you, as you said, you're a new issuer of ETFs. You've been a user and an investor in the past. But what is something that has surprised you over the past year, both from the product development side and then for your first few months post-launch?
Well, I think the first biggest surprise for me was just how much fun a button push was. I thought that was a total blast. And if you haven't done it, start up an ETF and go push a button. It's a lot of fun. But I think for me personally, I was a portfolio manager. I was working with my clients. We saw a need to be able to to stay on top of the benchmark, get that wonderful liquidity, the flexibility, that point on the curve, and turn around and put it into something that was tax efficient, paid out the interest rate on a monthly basis, and also had even better liquidity than the underlying, which is hard to believe, but it actually can happen. And so I was like, well, this will be great. We can use this in all of our strategies. And I think if we can use it in all of our strategies with all of our customers, other people can use it too. And so we took it to that, okay, this is a great idea. And then you find out what it takes to do an ETF. And it's like, okay, we had 40 Act funds inside of FM. We knew how to do 40 Act funds. But now we had this whole nother layer that Chris and that whole group talked about, which is market makers. And you have to help the market makers, and you got to attract their attention. As he said, they'll talk to you if you're going to do 1 million shares a day. If you're just coming onto the scene, you might get a 10-minute commercial with them. That's about it. So fortunately, we were unique enough that we were able to get the market makers in there. Then it came to, okay, how are we going to broadcast this? How are we going to get our data out there? How are we going to get all this other stuff? Because I went basically from being a portfolio manager to running a public company. And that was really the biggest surprise for me was, holy cow, I now have investor relations and press releases. I was telling Ali before this, they had a phone up at FM, we're out of Washington, D.C. It never rang. Why? It was the general line, and they just didn't have, they put it out there because they have to have a general line. First day we list, the phone rings, they're like, what's that line? And the next thing you know, we're training operations people on how to answer the phone and answer questions on the ETFs because, we didn't think about the fact that we need to have an investor relations. Now we've taken care of that and we've built all of that up, but it was really just that whole learning curve that with the successful ETF and all the press we've gotten kind of came at us with a fire hose.
Good problems to have, I guess. Yeah. So Kurt, the incorporation of data has become increasingly important, really, I feel like in everything that we do. How have you found that, Syntax effectively uses data really in general, but then when thinking about constructing innovative ETFs?
So the best way to answer that is to give an overview of Syntax, right? So the firm for the past 20 years wrote a language, interpreted the language, and then integrated that into a database of the most granular, precise, and multidimensional information that can be queried at any time for any specific portfolio manager, strategist, research team, etc. So when we break it all down, the information flow that's coming to us and the requests that are coming to us from multiple different institutions across multiple channels, without a doubt, it is into thematics. High conviction, narrow portfolios that are specific to individuals' desire to find dislocations in the market or build out themes or create something that is either not there or they want a better access point to it. And so when we talk about how to use data, our stuff goes from 180,000 citations to 11,000 companies to 8,000 barcodes to 40 specific lenses. So it's all about the barcodes, right? How can we align specific queries with what you want precisely so you know exactly what you get? And ultimately, what that comes out from is it can be broad-based, large, wide indices, or very narrow, specific portfolios like we're running within thematics. And it's even coming down to further where it's 1 to 3 individual equities. But the data that's being deployed, it's getting narrow fast. And so it's a blast.
Okay, so then, Pete, I think you brought up a good point of, the products that you brought to market were new. There was nothing like them in the market at the time. And, people always say that necessity is the mother of invention. So I want to throw this to Pete and Andrew, but I feel like all 4 of you would have ideas on this. What holes, maybe Andrew, I'll start with you. What holes did you see in the market when you think about some of the products that you've helped bring to market, that you were looking to fill?
Yeah, so when you're launching a new product that's first to market, you don't know what the response will be. You don't know how many potential investors are looking at investing into this theme or what percentage they'd be willing to invest in. And then you hit the hurdles of all these companies that are really interested in investing, but they have mandates where they can't be larger than a certain percentage of ownership, and that becomes an issue for them investing. So you have a lot of people waiting on the side, waiting to invest. But what we have noticed is there are, depending on the product that you're bringing out, if there is significant demand, sometimes gatekeepers will make exceptions and they'll allow certain products on earlier. I think one of the best examples of that was when PIMCO launched their total return fund. The ETF wasn't approved on many platforms, but the total return ETF was actually doing better than the incumbent mutual fund. And all the investors on the platform were saying, hey, why can't we invest in this better performing version of a similar fund? And sometimes that happens, but it's a really rare case. But for us, it's really making sure that we're trying to launch products that we think are long-term strategies. Ideally, they're multi-trillion-dollar industries within several years, and these are industries that we think people are talking about them, but they're not necessarily thinking about investing in them or knowing necessarily how to invest in them or which companies to pick. And so for us, sometimes it's ideas coming from other people saying, hey, I want this type of exposure. When we started looking into building a natural disaster recovery strategy product, it actually started with conversations with Barry Ritholtz and some others about what's wrong with ESG and climate change funds and renewable funds. There should be a different way of going about and doing this, and that's how our FEMA ETF was born. Sometimes it's other people showing you the light. Sometimes it's ideas that you have. But being first is really important because lots of times if you're not first, other people will come up with that idea. And sometimes you see 4 strategies that are really similar from different issuers all launching at the same time too. So one of those beauties of being small and being nimble, but you also have to do a really good job of getting the marketing power out there and having the ability to stay in the game in case the assets don't come in on day one.
Yeah.
So when we looked at the bond market, we've had 10 years of terrible interest rates. Nobody wanted to innovate in the bond market because what do you sell in bonds? You sell yield and some safety, but stocks were doing great. You don't need safety. So what we saw coming here when rates were going up, and we also saw the volatility coming up, we see this as a great time to start doing the innovation in the bond world that you didn't have, because we're still pretty much stuck at, there's a little bit of innovation going on and they're awesome products, but we're still pretty much stuck at the S&P 500 space in bond world. So I'm excited that, I actually looked at doing a fixed income management ETF product, and I'm like, I can't find the ETFs, and this was pre, my current position. But I couldn't find the ETFs to do the things that I needed to do to be able to buy and put it into a fixed income strategy. So I'm glad to see that with the yield, maybe I'll do all of the ETFs, maybe other folks will do the ETFs, but we'll be able to start bringing more opportunities to get into bonds so that people can understand bonds, put them in their portfolios. Maybe I'm the first bond that somebody buys. That would be exciting to me. And then they go, wow, I can actually make money in bonds and stocks. And then that would be great because bonds need to be parts of people's portfolios. They need to become a bigger part of the conversation. And so I hope with this new interest rate that we have, that we can start bringing that out there and people will be excited about bonds and really helping that part out.
Kurt, Bruce, anything you'd add?
Yeah, I would add, the sophistication of the strategies that have been launched in ETF format over the last 5 to 10 years has really grown tremendously. You've seen what were previously known as hedge fund strategies, come out in the form of ETFs, and I think that's a good development, really. It gives more tools in the toolkit for an advisor. From the night shares perspective, we found a quant signal that we found ourselves, and it turns out that the daytime and the nighttime perform very differently. The night has more of the return, and the day has more of the volatility. But I was very excited that we found some academic backing for it. I didn't realize this. For 25 years, people have been writing about this, and I just wasn't exposed to it. So for me, that was a very powerful sort of backing of the concept. But I think there's other strategies like that have been sort of sophisticated, and the ETF format is a great one for launching. So I think that trend will continue.
Bruce, I'll stick with you. Kurt, go ahead.
Yeah, I was just going to say on that note that we're a data provider, so we are product and process agnostic, right? We're not out to build a specific targeted ETF or product, if you will, that's in this arena. We'll provide the data that gives you precision and accuracy to go any route you want, whether that's in EV future transportation, life underwater that's aligned with the SDG goals from the United Nations, if it's a pure sports play, whatever it may be, we'll be able to concentrate that into a very specific and narrow query and deliver it. I think our value comes from not just the data, but how well can we serve the client base that we're now working with across the 7 different channels. So that's our value prop.
Yeah. Bruce, I'll go back to you for a second. Part of innovation is taking risks. Sometimes it's even, failures. What is a risk you feel like you took with your respective product lineup at Night Shares when it comes to being innovative?
I think the biggest risk is that the concept is unknown. And whereas we did some market research, we ran it by some people, sometimes you just have to launch the product to get it out there. The good news is, like I said, it's backed up by a lot of academic research over 25 years. Another risk we took is we basically named the company after the concept, right? We're kind of all in on it. Night Shares is the company and the funds. And, but I think that beyond that, it's just the risk of being a startup. It's the ETF game has changed. Early on in both of my previous ETF businesses, it was relatively easy to get in front of the customers. One, because there were only early on maybe 15 sponsors who were active. There was thirst for product. I mean, in the early days, there were people saying, what I really want is this ETF. Now you don't hear that very often. So it's a different dynamic. There's more consolidation of the the model builders, and there's more gatekeepers and all that. So I think there's more risk of a new upstart in general. But the numbers will tell you in the ETF business there have been plenty of them. So, and as Andrew said, there's some that are having great success. So.
Do you feel like, when you were at iShares or Wisdom Tree and there were, as you said, only, fewer sponsors in the market, it was easier to be, take risks or be more innovative because there were fewer sponsors? Or now, as you've all mentioned, there are a lot, smaller, newer issuers. I feel like the gates have really opened for a lot of these new products. Which do you feel like was easier?
Yeah, I mean, the industry's really gone through what I would call 3 sort of periods of evolution. The first, in the early iShares days it was a land grab. That's what it was. We were just at iShares the most aggressive grabbing the land. We locked up as many indexes as we could. We got out to fixed income, and we just kept pushing. And we had a dedicated business unit, whereas some of the competitors had sort of people selling mutual funds and ETFs together. The second phase is this sort of, well, what does anyone else who wants to be in this business do? And that's, there were a lot of variations of smart beta indexes weighted differently, still a lot of first to markets, plenty of them. And then the third phase has been, more probably these thematics, hedge fund strategies, but certainly many, many more competitors, more mutual fund conversions. So, Different at different points in the cycle, there's different risks.
I think one thing that people that are new to the industry might not realize is, but in the early days of the ETF industry, almost every ETF was being launched on the American Stock Exchange, where you had specialists representing these funds. And part of the process was these companies that were about to launch ETFs would go to the specialist firms and basically say, how much seed will you put in our funds? And you would have essentially a bidding war of specialists saying, we will put this much seed day one into your fund, which basically made a lot of funds overnight successes.
The good old days.
Yeah, there's very little to no risk in launching it if you know you're going to have a ton of seed right out of the gate. Soon as things started moving electronically, that entire game disappeared, and there was so much emphasis on being able to market and promote your products. And that's something that, when I first started bringing ETFs to market, that was no longer part of that equation, and you really had to get your name out there. So the early days would have been incredible. I was on the wrong side then, but now it is certainly much tougher. But I think that's also something that people don't necessarily realize if they weren't there in the early days.
Yeah. Okay, so Kurt, turning it back to you, when we were talking initially, I know you've been through some M&A activity, in your career, which we've seen a lot of in the asset management industry. So having gone through that, at your prior firm when you sold the business to a private equity firm in 2016, what are some of the hurdles that you find firms face when trying to continue running their businesses and also looking to continue innovating at the same time when going through those transitions?
So almost going back to our keynote speaker this morning, liquidity events are great, right? When they work out. I mean, it provides a windfall, you execute on an idea, the process flows wonderfully if you are aligned with the right partner, right? So that knowing your partner is like critical along the path, because if you transact and the event occurs and everything is going along smoothly, and there's like no issues involved with being able to continue doing what you're doing day to day, or innovating, landing new platforms, creating deal flow, it all works out lovely. But if there's an individual or a venture or PE that comes along the pathway and all of a sudden starts to get in the mix of the current flow, it gets disruptive. So I think the biggest piece of it is staying in your lane, right, from the actual acquirer to the acquirees, so innovation doesn't get disrupted. You stay down the path of everybody focus on what you're doing really, really well, so there's no disruption along the pathway. I mean, I spent 25 years in asset management, Ali, and then the past 7 months have been distributing syntax commercially, and within asset management, it's almost like the best way to go about transacting is to find the closest ideas to yours without any hesitation. And it takes a long time, right? I mean, it took us 2 years to find the right buyer in 16, but it's worth it. Long process, but to create that continuity, it's worth it. So stay in your lane.
Bruce, I know you've also been through some, acquisitions when you were at iShares, or anyone else want to comment on that piece?
Let me get my thoughts together on that one.
So here's a question that, we'll start with Andrew, but I think we talked about this on our initial call, which kind of turning the tables on not necessarily innovation, but areas of the ETF industry that have stifled innovation. So Andrew, do you want to start with you?
Yeah, I think there are two areas. One, regulatory. So although the U.S. had been this bastion of freedom of launching incredible ideas in the form of ETFs, you see things like crypto, and regulators start to step in and slow things down. And this has actually been an area where Europe and other places abroad have actually been beneficiaries of our slow ability to progress and make rules for bringing, specifically in the area of cryptocurrencies, to market. And that's something that, where we have been this leader of innovation for ETPs, we've hit a roadblock on that, and someone else is now being the beneficiary of that outside the United States. But anyone here a gatekeeper? Any gatekeepers in here? No? Okay, well, if you're not familiar with them, they work at most of your well-known banks, and this was a role that wasn't really there in the ETF market in the early days either. But now, as a service to their customers, many of these firms, these large firms that have many different advisors all around the country, have put various restrictions and hurdles for products to get approved. Some of those are based on things like firm AUM. Some of them are based on product AUM. I've even heard arbitrary things like you need to have 13 employees at your firm. Well, when we first started, we had to go through these conversations, and it was, you need 50 million. And then 50 million in AUM said, no, you actually need 100 in AUM. Then it became 250, 500, and some places it's $1 billion in AUM. And this is tough. This is a hurdle for newer issuers. But you look at things like Reg BI and putting best interests out there, and it makes you wonder, is by putting restrictions on products that might be superior in every single way other than the name, brand, issuer on the product, they're being rejected or they're being walled off from being approved on platforms, at least on day one. So that's something that I think would be great to see a more open conversation and see a way for smaller issuers to be able to make it through there. Obviously, there are reasons that banks will tell you why they have these in place, but it does make you wonder if that does stifle innovation. If you have larger companies saying, you know what, we'll just copy the smaller guys because we'll get approved a lot faster. That's not really an industry that position that I think many people want to see. And I might be a little bit biased, but I think from an investor standpoint, are you necessarily getting the best product? Or are you getting something that's checked some of the boxes, and that's why you're getting that product?
Yeah, just on the regulatory side, I would say it's been harmful that ETFs have fallen under some rules that weren't created around ETFs, right? The 33 Act and the 34 Act. And so how does that play out in reality? So because we fall under the IPO rules when you're starting up a fund, you can't talk to anyone about it, right? So you can't really pre-sell your fund like you can a mutual fund, let's say. With the market makers, you fall under these market manipulation rules. The market makers are, as an ETF sponsor, they're my partners, but I can't treat them like partners, right? I can't pay them like partners. I can't strategize with them as partners because of the rules. So there's no real way to incubate an ETF the way there is with other structures, right? You just get to day one and you go for it. And I think that's an issue. I don't think the mutual fund industry, or the structure is better on too many things than the ETF, but that is one where it's a bit easier to just start it up a mutual fund, let it go, earn the track record. I could add another regulatory one that you can't use back tests and all this other stuff, but the lack of the ability to incubate an ETF, I think, is an issue, and I think the rules could easily be changed around that.
So know what you own, right? Your regulatory position kind of filters into precisely where around the United Nations Sustainable Development Goals, if you have aligned or misaligned companies within ESG, for those that are working or building product within ESG, there's no questioning where that falls from a company standpoint to know if they're completely aligned or misaligned, and where they fall within inside of that specific targeted goal is a game changer, because you can automatically answer any regulator's questions around what do you own and why do you own it. And from a data standpoint, I think that's the most imperative piece to the product build out. What's the mandate? Why do you own these equities? And what are they in there for?
Thanks, Kurt. So I took a little bit of different tact on where the problems are with innovation, and I tried to look at it from a corporate perspective. I've been an innovator pretty much since I started my career, always looking for something, different ways to do things better, faster, cheaper. And, if you think about it, you got to have that corporate culture around that supports people who are maybe coming up with ideas that are off the wall or against what we're doing, or it just sounds completely crazy. And we've all been involved in different innovations, especially the guys up here. And you look around and you go, okay, did that original idea actually end up being the end product? No, but it was the inception of that whole concept. That was the whole thinking line. And maybe other ideas came off of that. So you really have to be open to that. If the inception of this idea happened because my boss Alex called me up and says, "What are you doing?" And I said, well, I'm looking for the 10-year in an ETF. He's like, surely it's out there. And we're both pounding on the Bloomberg, and indeed it wasn't. And his next words were kind of like definitive, because I know at any other firm I was at, probably wouldn't have been, well, let's build it. And at that point, then everything for the rest of my year has changed. And so you've got to have that ability to say, let's do this. This is a good idea. Let's develop this. Let's keep moving forward with this. If you don't have that culture, then innovation is going to be really troublesome, because you'll have people that'll be like, well, okay, I'm not going to come up with any more ideas because somebody called me stupid. Okay, well, then that's done. And maybe it was a stupid idea, but you go down that line, you say, okay, well, it's good that you're thinking outside the box, but at least you're trying.
Yeah, I like that. So we're going to wrap up with one last question, but I did just want to ask the audience if there were any questions that you guys wanted to field. Yeah, go ahead.
For Kurt, hi, I'm Kevin. In the context of innovation, I got a two-part question. As you're beginning to introduce the data conversation to clients, what do these companies look like? Who are they in the marketplace in general? But I guess a bit of a devil's advocate. Don't they already have a lot of this data available to them?
Yeah. So the profile of the firms that are coming to Syntax for data, let's just say they're very deep in terms of capabilities from a research standpoint. Okay, so we're not looking, we're not having smaller RIAs, if you will, come into us. It's larger firms across multiple channels. So the 7 channels that we're talking about that are coming in, whether it's index providers, ETF issuers, large banks, wirehouses, pensions, the firms that have the capabilities already in the house that are building product to expand further down to that last comment about knowing what you own. So the profile is, it's almost like the higher we go with data, the more relevant we get. Because the current providers that are out there, they don't get near the granularity that we'll bring them, right? So we're talking, again, 8,000 global companies that have got, taxonomies that are very, very granular, all the way down to 3 to 5 specific companies within them. So the channels are wide. The firms that are coming in are large in scale, and the data that they're currently using, well, let's just say it's not bad. It just doesn't go that deep. So the question, Kevin, we ask PMs and CIOs and strategists is that, who are you working with, and are you getting what you need? It's not the question of your PM attributes, great work, process, awesome. Do you have the right data? And that, from a fintech standpoint, we think is a bit of a game changer, because when folks can all of a sudden be able to create and develop something that they think is right, and then we have a correlation analysis against what they currently have, that again, that's where the rubber meets the road from our standpoint. So hope that answers it.
Any other questions? Yeah. Hi.
For everyone on the panel, you talked earlier about hedge fund type products and ETFs. The SEC's rule right now, complex products. How do you walk that efficient frontier of innovation versus unnecessarily complex products that might inhibit distribution? Does that make sense?
Yeah, I made the comment about the hedge funds. I think the SEC's made it easier to get things like derivatives inside funds, right? So they've enabled strategies to come to market. I think it's still incumbent on the provider to explain them. They still have to, that's always going to be the litmus test, is to be useful to the investor, understandable. Like our ETFs are active, but they're transparent, systematic active, right? Everyone knows exactly what happens under the hood. And so that kind of trade, I think, is useful. But the activeness buys us some flexibility in our portfolio management process. So I don't know. I think I don't see that as been a hindrance, lately. I feel like the SEC with those new rules that, have allowed a lot of products to come to market. They have this derivatives oversight rule they put in place, which is not fun to comply with, but good for the investor, and has let the sponsors progress their businesses.
Just as a follow-up, I meant more the SEC as well, but Andrew had mentioned also some of the platforms. In a former life, when we had a product that we kind of mentioned if the hedge fund high return, the feedback was, well, that's a much more difficult product. We don't want you on the platform because our clients won't understand the product.
Yeah, no, sorry, I get it. I think, the people that are building models want to be different, right? Sometimes. Sometimes they want to, be tracking, basic stuff, and sometimes they want to be different. And this was a year, it certainly paid to be different, right? A lot of these alternative strategies wildly outperformed 60-40 this year, right? So I think that helps. And I think there seems to be much more understanding of products that do different things, that have asymmetric payoffs, that have leverage. It's not seeming to be as scary as it once was. So, I think these products are finding their way.
Andrew, I guess also as a follow-up to, you talked about the gatekeepers, are there certain metrics right now that you feel like aren't being, either valued or evaluated as much as they should be by these gatekeepers, and focusing on the AUM or, other characteristics?
Yeah, and kind of to the question, product structure. If you're, what is the risk if you're investing in, domestic equities? You're probably already investing in domestic equities. Putting in an ETF wrapper, is that making it so much different or so much riskier? Obviously, there's issuer risk, and there's other parties that are involved beyond just investing in a single name equity. But they want to know everything, and which is fine, because ETFs, some of them are about transparency, and so that's part of the game. But there's so much weight to AUM that you have, and that's maybe not as important, because many of these platforms will say, okay, you need to have this much in AUM in a product, but maybe going forward, any new products that you bring on, once they hit a lower threshold, then it's okay. I think they'll tell you that it has to do with the staying power of the issuer, or the ability for that issuer to service their channel and educate their people. But sometimes they're very simple strategies, passive methodologies that people can understand. Certainly talk to your financial advisor, read the fund's prospectus. That's where you'll learn the things that you need to know. But some of these might be fairly arbitrary reasons to use as a reason to exclude someone from a platform.
Any other audience questions? Okay, so Pete, maybe we'll start with you for this last one, and you can really take it one of two ways. What are some of the most important innovations that we've seen in ETFs, either over the past 20 years, or you think will come in the next 20 years?
Well, as I was giving this some thinking, you got to go back to the spiders, the S&P 500. You got to go to GLD. You go to Rule 611, you go through a lot of the different things that have happened. I think anything that really brings people the ability, and I don't want to use this the wrong term because I've used this a lot, but democratizes the ability to get into efficiently into different strategies or into different securities cleanly and cheaply and easily. That's going to be the main thing that's going to drive the innovation going forward. There's a lot of people out there with a lot of assets under management that can't get into some of the strategies and some of the investments that you can sitting at the big shops. And so if we can take ETFs and bring those strategies down to these very intelligent people who just don't have that kind of access, bring that down to them, they're going to support those products, and you're going to see innovation.
Kurt, yeah.
So going forward, since the landscape's already laid out, high conviction, narrow portfolios that are thematically driven. Without a doubt, that's what's coming at us from the largest firms across the industry. And it's not slowing. So this panel is innovation, right? And it feels like the juices are just starting to reignite, because you can get exactly what individuals want to build, precisely, narrowly, and accurately. So thematics.
I think the biggest innovation historically has been fixed income ETFs, because you've taken a market that was off exchange and basically brought it on exchange. You know, I remember when we were launching fixed income, we started asking these questions like, why is there no bond exchange, right? And of course, the answer is complicated, including the fact the industry probably doesn't want it. But, today there's massive liquidity on fixed income ETFs that have been brought on exchange. In many cases, the ETF liquidity exceeds the liquidity of the underlying asset class. So I think that's pretty interesting. Going forward, I think innovations that help the users of these products who have to sift through 3,000 options just really understand with great clarity what exposures they're actually getting and what is the intent of the product. And, is it, are there 10 products that basically look the same, or are those some that are really doing something really different?
Proxies. Proxies are so difficult for ETF companies to get votes on, and it really is a deterrence. And when you look at potential M&A and roll-up strategies and things that could be done in the ETF industry, one of the toughest roadblocks is, okay, you might do a deal, but can you actually proxy these products over? I think that's something that should probably be reviewed. I know the SEC is looking at changing things with proxies, actually probably making it more difficult for all of us and taking it a couple steps backwards. But I think that's an area that could actually see a lot of new M&A in this industry, and that's a major roadblock. And I think if something's done, you could probably do it where it's good for shareholders, good for market participants, good for stakeholders. But that's something that I think should probably be reviewed.
Yeah, that's a good one. Any other final comments, thoughts from the panelists?
Come meet us at our booth.
Yeah. All right. Well, thanks, everyone.
Thanks, Al.
Thanks.
Thanks, Ali.